Welcome to the Trading Tutor. This video presentation is the second segment of options and futures trading terms and vocabulary. In this section, we will focus on volatility, the Greeks, defined risk, and other important trading and derivative terms. Let's begin. Volatility. When derivative traders look at the market, they will analyze two main types of volatility: historical volatility, as well as implied volatility. Okay, let's first take a look at historical volatility. Historical volatility, often known as statistical volatility, refers to the measure of past price movements of the underlying asset. It is a statistical measure that quantifies the degree of fluctuation in the price of that asset over a specific period of time in the past. Now let's compare that to implied volatility. Implied volatility measures the anticipated volatility of an underlying asset. It is calculated by using the current market prices of the underlying asset and its option price. It measures how much market participants expect the price of an asset to move in the future. Now let's take a look at the relationship between volatility and option prices. As volatility increases, the prices of options become more expensive. Alternatively, when volatility decreases, option prices become less expensive. Now we will move on to the Greeks. The five main Greeks that make up an option pricing model are delta, gamma, vega, theta, and rho. First up, delta. The delta, also referred to as the hedge ratio, measures the sensitivity of the option's price to changes in the price of the underlying asset. It represents the expected change in the option's price for a 1-point change in the price of the underlying asset. A call has a positive delta, and a put will have a negative delta. The delta values range from -1 to +1. The next Greek is gamma. Gamma measures the rate of change of an option's delta in response to a 1-point change in the price of the underlying asset. In simpler terms, gamma indicates how much the delta of an option will change when the price of the underlying asset moves. The next up is vega. We all know how important implied volatility is to options traders. Vega is the Greek that measures an option's sensitivity to implied volatility. It is the change in the option's price for a 1-point change in implied volatility. Moving on to theta. Theta, also known as time decay, measures how much value an option loses for each day of time that passes. And last up is rho. Rho is the rate at which the price of a derivative changes relative to a change in the risk-free rate of interest. Moving on, let's take a look at margin. Margin refers to the amount of money or securities that an investor must deposit with a broker in order to cover a portion of the potential losses associated with certain financial transactions, such as trading stocks, options, or futures. It acts as a security deposit and is used to ensure that the investor has enough funds to cover potential losses and meet financial obligations. Margin requirements are established by the Federal Reserve Board under Regulation T and vary based on the type of trading account. Another important concept for traders to understand is their cost to carry. The cost of carry refers to the expense of holding an investment position. It can take numerous forms, such as interest on margins or loans used to complete the trade, or the costs of storing a commodity. It can include costs that can arise from keeping a position open. Changes in interest rates can necessitate a charge on your account, or overnight funding charges can be incurred. The cost of carry of a position varies depending on the type of trade and asset being traded. Now let's look at defined risk versus undefined risk as it applies to option trading. A defined risk strategy, as it applies to options trading, is a strategy where the maximum potential loss is known and limited at the time of entering the trade. An undefined risk strategy is an options trading strategy where the potential loss is not capped or is theoretically unlimited. Defined risk positions give the peace of mind of knowing the worst-case scenario on trade entry, while undefined risk positions obviously leave the worst-case outcome as an unknown over its life. Additionally, defined risk trades require less capital and can help enhance returns while limiting risk. In closing out this presentation, let's lastly explore beta. Beta is a measure of a stock's sensitivity to market movements, particularly in relation to a benchmark index. It quantifies the degree to which the price of a security tends to move in relation to the overall market. Beta is a crucial metric used in finance to assess an investment's risk and volatility. This concludes part 2 of our derivative vocabulary presentation. Stay tuned for future lessons. Have a great day.